Hey everyone, this week I'm going to focus on two economic forces that probably have the greatest impact on commercial real estate investors: job creation and interest rates. Ironically, this is the cornerstone of the Federal Reserve's dual mandate. The Federal Reserve has two primary responsibilities. The first is maintaining price stability, basically keeping inflation in check. And their primary tool to do this is raising and lowering interest rates. Their second mandate is to maximize sustainable employment, basically create jobs. And if you listen to Chairman Powell's speech a couple weeks ago at Jackson Hole, one of the key inflation challenges he mentioned was tied to the employment market: elevated wage growth. At a very simplistic level, if there are too many jobs available, then companies compete for workers and wages tend to go up. That in turn puts upward pressure on inflation, which then causes the Fed to raise interest rates. On the other hand, if the Fed pushes interest rates too high, the economy could contract, which in turn results in job losses. So in our current economic climate, it's hard for investors to get the best of both worlds. The Fed's trying to thread the needle. They're trying to achieve a proverbial soft landing where job creation remains positive, but not so strong that it drives inflation up. And so far, it seems like the Federal Reserve is doing a pretty good job of balancing these forces. The US has added about 1.9 million jobs so far this year, but the pace of hiring has been slowing. In the first 3 months of 2023, we added an average of 312,000 jobs per month. In the second quarter, the US averaged 201,000 jobs per month, and in the months of July and August, the US averaged 172,000 jobs per month. That puts us on track to add somewhere between 2 and 2.5 million jobs this year, which is right on target with the 10-year average from 2010 through 2019, which was 2.2 million jobs per year. That decade was pretty good for commercial real estate. In that 10-year span, the US absorbed an average of 261,000 apartments per year, 83 million square feet of retail, 85 million square feet of office space, and 240 million square feet of industrial space per year. Now, it looks like absorption in 2023 will fall short of that average, especially for office. But if the Fed can achieve the soft landing, confidence levels should continue to rise and absorption could begin to strengthen in 2024. The other major component of the employment market we need to watch, though, is the number of job openings. The total number of job openings in the US peaked in March of last year at just north of 12 million vacant positions. Since then, job openings have steadily shrunk and now stand at 8.8 million, the lowest level we've seen since March 2021. The greatest reduction of job openings was in the retail and professional and business services sectors. There were also sizable reductions in the number of open positions in the manufacturing, the wholesale trade sector, the leisure and hospitality sector, and the healthcare and education sector. Interestingly, there are more open positions today than there were in March of last year in the transportation and warehousing sector and the information sector, which includes the software technology group. But we still have a significant labor shortage, with just 5.8 million people looking for work as of July. The spread between the number of job openings and the number of unemployed is down to about 3 million, which is half of what it was last year in March. As a result, wage growth has been coming down. When the labor shortage was greatest, wage growth was about 6%, and as of the last reading in August, wage growth was down to about 4.3%. Ultimately, I think the Fed wants to see wage growth somewhere in the low 3% range, about where it was in 2019. So there's still a ways to go. The big question is whether wage growth is coming down fast enough for the Fed. Most other inflation forces are settling into alignment with where the Fed would like to see them. So if the Fed's happy with how fast wage growth is slowing, then the Fed will likely keep interest rates flat. And at this point, Wall Street sees a 93% chance the Fed will keep rates flat in September. As for the remainder of the year, Wall Street shows it's a coin toss with a 50-50 chance rates will remain unchanged through year end. So, from a big picture standpoint, job creation has slowed back into alignment with the pre-pandemic average. The number of job openings is shrinking, as is the labor shortage. And wage growth is making meaningful headway back toward normal. And that's good news for investors. The outlook is improving, but there's still a ways to go. That's why investors need to keep their eyes on the horizon.